Hello traders, welcome to our volume profile course. I'm Juan Maldonado from the Elliott Wave Street, and it's a pleasure to be with you today. We are live, it's 8 p.m. New York time, and we are going to talk about this great tool. No matter what time frame you are trading, no matter what market you are trading, from stocks, individual stocks, to futures or currencies or cryptocurrencies or anything you wanna trade, you can use this great tool. We are going to see some examples on some markets, but all the things that you are going to learn today, you can apply it immediately in your charts, and you can apply this knowledge on any market. Let's start with my presentation. I'm Juan Maldonado. I'm the founder and CEO of Elliott Wave Street. I'm a professional trader and analyst. I have a degree in finance and international trade, and I have been contributing for FX Street, Money Show, and investing. I am an international speaker, and I am a member of the CMT. When I went out of the university, I have a clear view of my life as a trader. I worked for an institution after university, but I didn't like that, working for someone else. So I started my own business, my trading business, and I started learning Elliott Wave, the Elliott Wave theory. Oh, it was a nightmare. That was more like 15 years ago. It was a nightmare when I started learning the Elliott Wave theory. And it took me a lot of time, a lot of resources to learn it. So finally I did it. And since then I have been completely into Elliott Wave. I have been, then once I started to be successful on the markets and successful with Elliott Wave, um, I wanted to share all the things that I was learning and that I have learned with Elliott Wave. So that's why I started to teach how to trade, to share my wave counts, and I have been doing this for over 10 years. Uh, every day publishing articles for my members, for my clients, um, teaching, and all the things that I really love. I love this life of sharing knowledge, of trading the live markets with my clients, with my traders. Let's talk about now about the market profile before we get into the volume profile, because volume profile comes actually from the market profile technique. Market profile was created by Peter Steinmeier for the CME, um, the Chicago Exchange. So actually, it's a registered trademark, the market profile, and you have to pay some good money in order to get those charts of market profile. It's a discretionary technique that reveals information that you can't see with your naked eye. It does not provide an accurate market entry, but the information that provides is key. But don't worry, you don't need to pay a lot of money monthly to get this data, to pay for the indicator, for the license, because we have volume profile. You are going to see the difference during the presentation. Before we get into the profile, there are some basic rules that we need to recap, or if it's the first time you're seeing this, to understand them very well, because this is important when you are trading the markets. First of all, when there is more volume in the demand, more buyers, more volume actually, the price goes up, right? When there is more volume in the supply side, we are going to have the price going lower. And when we have the volume that equals the demand and supply, we are not going to have a movement. The price is going to be sideways. And that's where the big guys are doing their trades. Because if imagine you are an institutional trader and you want to buy the euro dollar or the S&P or oil, whatever, if you're an institutional trader, you need to jump into the market with a big position because you have a lot of money, you have a huge account. But if you do it all at once, if you put all your trade all at once in one position, first of all, you are not going to have a good price, because with that effort, the market is going to start going up. Let's say that you buy 10,000 lots of euro dollar. That type of order is going to move the market. So you can't do this thing all at the same time. You need to start buying in pieces, in parts. So when the market starts going sideways, that's where the institutional traders are doing their trades. That's where they are hiding, because they don't want you to know where the market is going. This is accumulation when they are doing this thing. So once they finish their accumulation, they start putting more volume, and they start moving the price, and then they take their profits. But those sideways areas, when we have the almost the same supply and demand, is where the institutional traders are doing their big movements. But they take advantage of the sideways price action in order to trigger the trades slowly, because they can't go with a huge position, because then we are going to see what they are doing, and it's going to be very easy for us to follow. And they are, of course, interested that we lose our money. They don't want us to make money. The market wants for us to leave our money there in the market. That's why more than 90% of traders lose their money trading the markets, because it's difficult. So buyers and sellers agree the price of the instrument and has the right price considering the underlying fundamentals. So that's important, but this is more important. This is the Gauss bell, and mainly what we have here, to make it easy, is that this theory says from the statistics that 68.2% right here, the green zone, is one standard deviation. So that means that 68.2% of the data is going to be here. Let's make a simple example, because I don't want to confuse you. This is so simple that I want to explain it in the best way possible. Now, let's suppose that you want to sell iPhones. You are the owner of Apple Computer, and you want to start selling your new iPhone 12. And let's say that right here on the left of the profile, you are going to sell each iPhone at $1. And right here at the other side of the profile, you are going to sell each iPhone at $1 million per iPhone. And let's say that the middle is going to be $1,000 for each iPhone, right here at the middle. So if you sell your iPhone at $1 million, probably you are going to sell 1 or 2 units, 3 units, and that's it. That's what you're going to sell. And if you sell it for $1, you are going to sell millions of units, but you're not going to make money because it's too low. You are not going to make even enough to for the cost, to cover the cost of each iPhone. So what you do, you make a statistical study, and you start saying, okay, so who is going to pay let's say $20 right here at the beginning of the profile, at the beginning of the green zone, and who is going to pay $10,000? And you start doing that poll, you start doing your market research, and then you find that the best price is $1,000, because it's where enough people is going to buy, and you are going to be able to make most of your profit at this area. All right? So that means that 68.2% of the people who is going to buy the iPhone, it's going to buy it from between $20 and $10,000. But most of them, if you place the price at $1,000, is where you are going to make most of your money. So that's the ideal price. That's the best price. Now, if you're a retailer, if you're a trader, if you're an iPhone trader, of course, you want to buy as close as possible to the left side of the profile and sell as close as possible to the right side of the profile to make more money, to have a bigger spread. And that will make more money for you if you're a retailer and you buy at wholesale prices with a good discount. And then because the iPhone is so successful that it runs out on all the stores, you can go on eBay and you start posting the price on the iPhone higher, for example, and you are going to make more money, right? So as traders, one of the things that we need to start seeing from the profile is that we need to trade when the price is cheap, when the price is at the left side of the profile, let's call it like that. And then we need to buy here. Let's say we buy Euro, or we buy Apple, right? Or we buy anything that you can think about, any instrument. And then once the price becomes expensive in the future, we are going to sell it as close as possible to the extreme of the profile. We have that advantage over the institutions because they can't trade, because their positions are so huge that the price is not going to resist that amount of volume at the extremes. But because we don't trade at those volumes, we can take advantage of that, and we can trade at those levels to buy cheap, sell expensive. But still, how we can bring the Gauss bell to our charts. How we can move this theory of the profile to the chart. Because look, here we can see when the market is sideways, and again, this can be any market, any instrument. When the market is sideways is when the big guys, when the institutions are trading. For example, in this Euro chart, they were accumulating orders here because they like to hide their orders in the sideways market. Then they leave the price go higher, and this is a market extreme with low volume. You are going to see why during the presentation, so don't worry about it now. But low volume, and there they take their profits, and that's why the market goes down, because they are there, and then they repeat the process. So here they start doing accumulation, and they leave the price run, and once it reaches one level where there are no more sellers, they take their profits, and it jumps back here, and they repeat and repeat the process. But how we can move this theory into the chart? How we can know, how we can tell, how we can use this tool to move to understand the profile? Well, this is the first question I think that we can come when we are studying this thing. And when we are checking the bell from this perspective, it's difficult for our eyes, for our brains to see, well, what we can do here. The price goes up and down, and that means that here was the strongest volume, but doesn't have any sense, because how I can tell if the strongest volume was at the beginning or at the end? Well, let's make this trick together. So please, bell chart, do your thing. Oh yeah, now makes more sense, because when we move the bell like this and we add the price, now we are seeing the relation. So for the volume profile technique, we are going to use the bell in this shape, in this way on the chart. So mainly the strongest part of the volume is going to be here. Don't worry about it. I'm going to show you a lot of examples coming up, but this is the price where most institutional traders were trading. Here was the cheapest price, and here is an expensive price. So with this example, some of the things that you start seeing is that you are not going to sell when you are at the lower side of the profile. You are not going to buy when you are at the upper side of the profile. It's too late. So some traders that are using their techniques, that are using their moving average techniques, price action techniques, fantastic techniques that you can use as well, but maybe you are using them in the wrong place at the wrong time. It's possible, right? But don't worry, I know that is a lot to absorb. So we are going to check a lot of examples. Before we get deeply into volume profile, let me show you the market profile. So remember, the volume profile is coming from the market profile. This is a market profile chart that each letter that you have here, it's called a TPO, time price opportunity, and this chart is not related with a time because each is just price. But you can see that it creates the bells, the profiles, right? It creates the profiles. But in order to get this type of chart, you need to pay a lot of money because you need to pay the indicator, you have to pay the data. It's expensive, and from my point of view, completely unnecessary. Because we can do the same with volume profile, exactly the same. So reading these charts, the time price opportunity is more complex. It's difficult because in 24-hour markets, when this technique was designed, they used to day trade in the Chicago exchange from the opening of the exchange to the close of the exchange, and that was it. So it was easier. But now we are in 24 markets, so we don't know. It's not too clear when is the open of the market. Is at the New York time in the morning, or is when it closes at 5 p.m. as the futures when they open? So it's more complex now. But don't worry, because the solution is volume profile. So volume profile is a tool that is almost, and we are going to check some real data with the volume profile to compare, but is almost identical to the market profile. Is 90% a market profile, the volume profile tool. More than enough, because here we are not looking for precision, we are looking for areas where the price is cheap or expensive. It can be applied to any market per session or cycle. You can do this thing on the 5-minute chart, the 1-minute chart, or the daily chart. It's like the Fibonacci tool. It's actually pretty similar, the application with the Fibonacci tool. And you don't need to have expensive data. You don't have to pay a lot of money. And all the market profile techniques that you're going to learn here, that you can learn in books, whatever, you can apply them in the volume profile without any issue. Let's start from the beginning explaining the profile. So first of all, there is a total area. The total area of the profile is all the price that you are measuring. So in this case, it's starting from here, and I'm going all the way up. So as you can see, all this data is the total area. Because we want to work with one standard deviation, remember our exercise about the bell at the beginning, is the one standard deviation is 68.2%. So because it doesn't matter to be exact, to be precise, we always use 70%. Why? Because it's close to 68%. And this area that you have inside the orange lines, that is the 70% of the total area. The indicator is going to make this for you, so don't worry. And that means that 70% of the volume on this chart was traded inside this area. Here, the institutional traders were taking their positions right there. We also have the value area high, that is the top of the profile right here. That's the value area high, right? Makes sense because it's the top of the 70%. We have the value area low, that is the lower side of the profile, the 70% of the profile. We have values at each node, as you can see. If we are connected to the exchange, we can see precisely the volumes at each node, at each bar. Let's say, for example, this one, 3.955 million was sellers at that point, and 3.86 buyers at that point. So maybe you can use this as a contrarian indicator, because we know that most of the volume is wrong in the markets. So it would be good to use it as a contrarian indicator. That's the way I use it. And the colors of the profile, as you can see, we have a red and green. By default, for example, TradingView has a blue and yellow. So it doesn't matter what colors you are using. I like red and green because it's more like red for sellers and green for buyers. So it makes more sense to me, but you can customize the colors, right? And we have the point of control, the POC. The POC is the strongest, this red line here, the strongest volume during that time. So we can say that that's the fair price. If you were trading Apple and you were able to buy Apple below the point of control, let's say you buy it down here, wow, you are a fantastic trader because you are far from the point of control. That is the fair price. That is where most of people are taking their trades. So you are really smart because you buy the stock far from the point of control. And if you are looking for a short, you are going to find it with your other techniques. I don't know, a breakout of the trend line, a moving average crossover, a divergence, a price action technique, anything that you like to use, you are going to sell it far from the point of control. Then you are doing well. Now, what if you try to buy at this area? Oh, you have a value problem. You are buying too expensive, my friend. You can buy close to point of control or far to the downside of the point of control, but never buy above point of control. It's too expensive. So look, this tool is telling when the market is expensive and when it's cheap. We also have some gaps. Gaps in the profile is when you have, for example, this bar that you see that there is a bigger one here, and it's like a void area. Usually during those gaps, the price crosses very easily to the upside and then to the downside because there is not enough value at those areas. So when I mention gaps, you already know that it's a really low volume node on the profile. Sometimes we have several, and we are going to see some examples of that as well. So volume profile considers the area that we are studying. You can use session volume profile, so the session that starts at 5 p.m. for the futures, let's say the ES, and it ends at 5 p.m., so that's a session. Or the session in an individual stock that starts at 9:30 a.m. and closes at 4, that's a session volume. But also, you can pick areas, like the Fibonacci tool. You can say, okay, I want to check where was the most volume inside this area. That's another way to do it. In the value zone, most of the price is traded. So remember, this area, the 70%, is where most trades are placed. And the institutional traders, the big guys, they are trading here inside. Let me tell you something. For example, on the currency market, 90% of the volume is traded by 10 institutions around the globe. 90% of the volume is traded by 10 institutions around the globe. And most of that volume is coming from one institution, the Citibank. All right? So these guys are trading huge positions. And it's similar to the stock market. So they need this sideways price action to take their trades. And they know exactly, because they are not going to lose money. They know exactly where the market is going to break out. We don't know that. All right? We don't know just with the profile which way the market is going to break out. So, and they are not going to give this information that easy. They are not going to post some news in the Wall Street Journal saying, okay, traders, today we are accumulating positions on Apple because we want to break out to the upside. They are not going to call you and tell you the Citibank or a huge bank, JP Morgan, Goldman Sachs, they are not going to call you, hey, individual trader, you see that Apple is sideways? Yes, I see that. Oh, well, we are accumulating, surprise. Okay, I already know that because I have the profile in my chart. Okay, great. Now we are going to break out this thing to the upside to take our profits at the top. They are not going to give you that type of information. We know that they are accumulating. We don't know which side this thing is going to break out. We need to use other things, all right? But remember, always buy far from the point of control, sell far from the point of control higher. We're going to make a lot of exercises here, don't worry. So let's say before we go to the next slide, let's say that you are using the Elliott wave theory and you say, oh, this is a wave 3 because one on Elliott wave street teach me that this is a wave 3. Oh, this is a wave 4. Great, I'm going to the 1 minute chart and I'm going to buy it. Huge mistake, because you are buying too expensive. Your trade was somewhere here or here if you couldn't take it at the bottom. But when you are outside the profile, now you are thinking is to wait for wave 5 and sell it and target the point of control, because high volume nodes and the point of control are going to act as a magnet, and you are going to see how impressive this thing works. Once it gets apart from the point of control, it is likely to go back. Now, we are going to have some gaps like this one. So you see these low bars, and look the price, how it crossed those bars very easily. Sometimes, if the price starts consolidating under these gaps, we can trade the breakout, because that means that the institutional traders are using the low volume to make some movements, and we can trade the breakout of the gap. All right. So the levels, the high node levels on the profile, they act like magnets. The price really like to be there. And if the price falls to this area, it quickly visits the point of control, bounces off, and leaves a long shadow and continues to rise. You are not going to expect a consolidation in this area, I mean the gaps. If the price starts to trade in the rejection zone, it's fill the gap and then becomes accumulation zone. So let's say that here we have a value area, a main value area, right? At that moment, and the price goes outside here and it starts consolidating, we need to check the volume. If it starts increasing, then we know that the market has found some value there, and we have to be careful with the breakout. But if that consolidation is quick, we can trade the breakout. And most of the times, it's going to go like this one, really fast through those areas. There is no liquidity there. So this gives us a lot of information. Are you going to place a sell trade here? Of course not. The big guys are going to look for better value. So that's why the volume increases at this zone, because they are taking profits. Maybe they are doing distribution. Maybe they are doing accumulation. All those things you are going to learn it is one step at a time. So there is something else really important, and is that the volume profile is calculated by the time that the price spends on this area. So this volume profile is not coming from the real volume of the exchange. It's calculated by the platform based on the time that the price spends on each level. So we can say that the point of control is where most price was traded, because it was more time at that area. So don't worry, because sometimes we think on the futures market, on the currency market, on cryptocurrency markets, that we don't have the real volume. That is impossible to have the real volume on markets that are not traded in just one exchange. Well, it doesn't matter, because volume profile is coming from the time that the price is spending there, the time that the price spends at each level. Look, you can see in this chart that we have this orange line as the point of control. The price goes outside the value area, right? This is the value area. This is between the two blue lines. We know that is the 70% of the volume during this time on this picture. So if you are in this picture and you're in the live market and you are up here, one of the things that you are not going to do is to buy. That's the first thing. So you filter that out. Okay, you are not going to buy here. Too expensive. Now, you can sell if you have a divergence, if you have a 1, 2, 3 pattern, if you have a head and shoulders, whatever you like to use to find a reversal, because the profile itself is not going to give you a signal, but you can combine it with your strategy. You can combine it with Elliott wave if you like. We're going to make some exercises with that later into this class. But you can combine it with anything you like. And if you feel comfortable, you sell it. You leave the stop loss some points above the high. You see that there is low liquidity there. So you say, oh, okay, that's nice. And your target is going to be the point of control, or at least the value area high. You can take some profits there, but you are aiming to take most of your profits at the point of control. And look what happened next on this chart. Yes, we were here on the previous slide. The price goes down precisely to point of control, plays around with point of control, and then makes the next move again. So point of control is a great support or resistance, depending on the side that you are, to take profits and to know the value of the market. Let's check another example. This is the Aussie dollar. On the Aussie dollar, we have this profile. The price is comfortable. The price feels safe. You know, it's like it's home when it's at the point of control, when it's inside the value area. This is the value area, 70%. So price, oops, this one is straight. The price is really comfortable there. It's like the dream place for the price. It's its home. And once it goes outside, plus we don't have addition of volume, you can find a divergence. You can find a breakout of the trend line. Anything that you like to use. Candlestick patterns, Elliott wave reversals, whatever. And that's where you are going to sell, never to buy. So let's say that you are here. Let me go with a magenta arrow so you know where we are. Let's say that you are here at this area, and your trading system says, hey trader, take a buy trade on the 5-minute chart. Don't take it. You're too late. This is the worst price possible to buy. Even if you are trading the 1-minute chart, it doesn't matter. It's too late. Extremely late. Focus on selling. If you are using Elliott wave, I love to use Elliott wave, but you can say, oh, this is a wave 3, this is a wave 4, this is a wave 5, I have divergence, great, I want to sell it, I'm going to use the system to sell it, and I start just following the leg down, right? And that's it, and you just follow the leg down. And then you target the point of control. Right here, you target the point of control. Look, that's where the price goes. In this case, it goes to the low value area, and it bounces from there. You don't care. Don't try to start doing crazy things. You are not going to do anything inside the value area. Leave that for the institutions. You are not an institutional trader. So you have the advantage of trading at extremes because you are trading with a small account. You are trading with 10 lots, 20 lots. That's small. You are not trading, or less. Some traders are trading with micro lots. But you can take that advantage of trading at the extremes of the profile. That's a good price. Now, the Aussie, then after testing this point of control, look what the institutionals were doing. The institutional traders, remember, when they are these areas, they are planning something. They make a lot of money and they do something at these areas. You don't know with the profile if they are buying or selling. Later, with Elliott Wave and with price action techniques, we're going to start having an idea where they are going most of the times. But they are doing something there. So look, after the price here on the Aussie dollar went to the point of control to the value area, look what happened after that. It went higher. It went higher. So then at this area, it's a low volume area. You are not going to buy there. If you were able to buy below point of control, fantastic. Somewhere here maybe. But once the price started to depart north, to depart to the upside, and it started to get far from point of control, it's too expensive. Your train, your plane has gone. Don't try to catch it. Trust me, it's going to make you lose money. So, more examples are coming, but so volume in trading is essential data to know the moves that institutions are making. In the stock market and the futures market, it is easy to get the volume because they are centralized markets, right? They are connected to the exchange. But for example, in the Forex market, it's not possible to know it because we don't have a centralized market. So identify the value zones is a useful technique to know the volume concentration on any financial instrument. But if you don't have the data, even if you are trading stocks, you need to pay for good data. Don't worry, use volume profile. Remember, the more time the price spends in one place, the greater the volume is. Now, some people say, okay, sounds good, but I don't trust you. I don't trust what you are saying because volume, calculating the volume using a chart that is not connected to the volume of the exchange is not going to work. How you can tell, how you can know that most of the volume is where the price was most time traded? Well, look, here you have a chart connected directly to the futures market, to the CME, the E-mini on the S&P. And the next slide, this one, is a CFD where the volume profile is calculated without taking care of the real volume. Can you see a difference? Let's go back. Let's go to the next one. Let's go back. Don't worry, I'm going to show you both in a second. On the naked eye, the differences are nothing, small. Maybe one bar is greater than the other one. Look here. Pay attention here at these bars on the profile, on the CFD, right? If I go back, the other ones are a little bit greater on the real volume. That's it. Point of control, value area, and everything is the same. Look, let me show you both charts at the same time. So on the left, you have a chart with the real volume connected to the exchange, and on the right, you have the CFD of the S&P connected with any ex-broker that is not providing volume. The same thing. Volume profile is 90% or more of the real thing. Great. So the same is going to be on the Forex market. The same is going to be on Apple. The same is going to be on oil. It doesn't matter. Trust me, this thing is going to be the same. And then you're going to ask, well, but what about the values on each bar? Well, let's check. On the left, we have the ES with the real values coming from the exchange. Here at the bottom, I have the totals, here and here. So the totals on the real thing was 2.835 million, and here was 200.643K. Those are different, of course, because this one on the right is calculating by tick volume, and the left is a real thing. But which one is greater? Well, on the ES, we have greater, the one on the right, the buyers, is bigger than the one of the left. That's what we need to know. And on the right, CFD calculated by tick volume without the real volume, which one is greater? The right one. So we don't need to have exactly the number is going to provide the same information. The buyers are greater than the sellers. That's it. So don't worry, don't spend time, don't waste time. Think about real volume versus tick volume. This works perfect. And here comes one of the most important parts of this course. The fair price is the balance between supply and demand, right? But on the profile can have different shapes. So the best price, the point of equilibrium, is the point of control. You're already an expert on this topic. The point of control, and we have the value area and everything. Now, we have different types of distributions. We have the D shape, because it looks like a D, right? Capital D, D shape. The D shape is when we have most of the volume at the middle part of the price action that we are checking. That's the D. During the D, try to buy low and sell high. Now, the next one is the V, lowercase v shape, right here, the V shape. Why? Because the market is trending down and eventually volume starts picking up and we have a B, lowercase b. The lowercase b usually, it depends on the context, but usually is like a bearish flag. So here you have your flag, right? And most of the volume here is the point of control at the top side of the flag. So in this particular case, you can try to sell far from the point of control, here or here, whatever, because you have the B shape. And if you have enough momentum, and let's say we think that this is a wave 3 on Elliott wave and this is a wave 4, and we're expecting a wave 5, under these circumstances, we can sell it by going to lower time frames, but as far as possible from the point of control. And the next shape is the V shape, uppercase V shape, because the B shape is when we have a profile here, and then we have like another belly here, smaller of course, but we have another one. Well, this one is a V if we have it like here, but I have the profile at the other side, so you need to use a little your imagination, but you know what I mean. So the B shape is fantastic because it tells us that most volume was here. And when the price tried to explore the lower side, yeah, it was a good volume, but not as big as the one before. So this is likely to fail and reverse back to point of control. Coming back again to the lower case of V, the previous slide, the opposite, of course, will be the letter P. Right? If the price goes up and you have a consolidation and you have your volume profile right there, it's a bullish flag. So it will be the opposite of the lowercase b. Let's check this chart. So this is the Bitcoin on 2017. Do you remember the time where Bitcoin was the headline on almost all the newspapers, channels? Everybody was talking about Bitcoin, new millionaires, billionaires, because they bought a Bitcoin when it was low enough to buy a lot of units, and the Bitcoin went almost to the 20,000 area, and all the people was completely excited about Bitcoin, and everyone, even people who never have been in the markets, was telling, oh, Bitcoin, that's so great, I want to make money with the Bitcoin. But if you had the profile on that time, the value area was down here. And people who really make like good money were the ones that were able to buy below point of control, actually here. That was the point of control. That was the most valuable price, or around that area. For years, the point of control was there. But then, when the market started to participate, and it went outside the value area, what happened with the volume? The volume disappeared. Nobody was buying. Look, the volume. We have tiny bars. Yeah, it covered a lot because a lot of public participation. But if you check this chart, and we are on December 4th, November, whatever, here or here or here, is not a good level to buy if you check the profile, because the value was down here. At least buy at the value area, at least. But here we don't have any value. No big guys were doing anything here, just public participation. And if you know the Dow theory, we know that that's the worst place to invest. When an instrument becomes so popular that it starts being the cover of the magazine, oh, it's the worst place in terms of time to take a buy trade on that instrument. So of course it didn't have value. Now let's have a look at let's add the value area, the 70%, the real value on the Bitcoin, with those lines, and here that are the same lines. Of course, look what happened after that. There wasn't value, there wasn't volume, and the price collapsed where? To the value area, and it bounced from there to where? To the value area. And it bounced it up. I take this chart before the course, a couple of minutes before the course, so this is a real-time chart, let's call it like that. And we are far from the value. We know that the real value on the Bitcoin is there, not here. So this is a really interesting case of a study to show some of the rules. Now, today, I send you my live market analysis, the same market analysis that I share with my clients every day. And you're going to receive during this event, these days, my live market analysis on the recordings page. After I post for my clients first, then I post for you. And one of the trade plans that I was looking today was the Aussie dollar. And after the Aussie, we are going to check the live chart on the S&P, so I can show you my view on the live market. But here is the Aussie dollar, and this morning, this chart was taken from the members area. I take this chart from the members area, the same chart that was posted in the morning. And I was looking after the end of this wave 4 to sell it and to target this low, because it was the wave 4, because I'm looking for a leg down on the Aussie. And I was thinking that was over. You see the live market analysis today. So how we can use volume profile to have a good entry with Elliott wave, with this analysis? Good question, right? Let's have a look at the volume profile. So first of all, this is a 4-hour session volume profile. So each value area is a session, a 24-hour session, and all these red lines that you see across are point of controls. So today, I take my profits on the Aussie right here at this point of control, right there. I take my profits. And the price went up in a 3-wave sequence. We are going to zoom in into that profile. Let's zoom in now, 15-minute chart. So let's go back so you see what I'm doing. You see these two profiles right here? I'm going to zoom in by going to the 15-minute chart. Remember that the volume profile is not going to change if you switch from one time frame to the other. Always is going to be the same on all the time frames. And look, here we were this morning here when I was doing the analysis. So I checked the volume profile, and we were far from the previous day profile, and we were far this morning from the current volume profile. So we sell far from the point of control. We sell far from point of control. We can take some profits at point of control, but because I also have the Elliott wave analysis and also the higher time frame volume profile analysis on the previous chart, that I have another point of control here from previous session because they are useful forever. That was a good area to take profits at the low. So it was a great trade, and you see that one happening live today. You follow this one today. And what if I bring this chart to the doctor, and I say, hey doctor, this chart is so sick that it needs an X-ray. And the doctor will say, what? What do you mean? I can't make an X-ray to a chart. Are you crazy? The X-ray is only for humans. Well, and I tell the doctor, hey doctor, no, you're wrong. Trust me. Put this thing in the X-ray machine and let's see what happens. So the doctor says, okay, let's do it. And I tell the doctor, I ask the doctor only to do the X-ray of this area, because I have the session volume profile, but as a Fibonacci tool, I can also run the study during the corrective wave, because this is the wave 3, this is the wave 4, right? And then inside is a corrective wave. For a simple wave count, let's go with an ABC. It's more a WXY, but we are not going to talk about that today. An ABC, a 3-wave sequence. So the doctor says, okay, you are crazy, but let's use my X-ray machine and let's put this chart. And we did that this morning, and this is the result. So look, we were able, using that X-ray machine, to build a profile of the corrective Elliott wave. And if you remember the training today, this is a D, capital D, V shape. So nothing better than selling here at this area. That was the way forward. That is why this morning I said, oh, this is my favorite. I'm far from the point of control. I'm far from where the institutional traders were doing their thing. And here I don't have a volume. So this thing is likely to collapse and go at least to the point of control, and why not with all the other analysis to the previous low, right? And then when you have this picture, you start using your techniques, and you're going to say, oh, I remember that I learned a trend line. Well, selling here is too late. Well, I learned how to accelerate the trend line here. Well, selling here, good. You can do better. You can do better. Oh, I remember that I can accelerate this thing a little bit more, right? Or you can do a moving average crossover system, or you can use a candlestick pattern right here that is like a dark cloud cover, or you can use divergence, or you can use anything that you like. But you know that what you need to do is to sell, and then you apply all the tools, because you know that this is an area where the institutional traders are taking their profits. Now, if at this area the price starts accumulating or doing the distribution, whatever, sideways, and you have a huge volume profile because it can change, right? Then you are going to be more careful, because they could be planning to break out to the upside or to the downside. You don't know. But if the price goes out there, this is the way forward, and you see that it starts working quickly, you keep the trade. That's it. Common sense, right? Because remember, this is not something that you say, okay, this is trading doing 2 + 2 = 4. Great, I'm a millionaire. I'm making money. Trading doesn't work like that. Trading is difficult. Trading is challenging. But with these tools, you're going to understand better what the market is doing. All right, now let's go to the live charts, because I want to do with you here together some analysis on the ES, on the S&P. So before we talk about the profiles, let me show you my live Elliott wave analysis on the ES, on the S&P. I believe that the S&P wants to give us a high. So my target is the previous high. Here is the index. So it's like 10 points off than the ES, but it's the same structure and everything. So look, I'm here at a market extreme. Even if I don't have the profile tool, and if I want to do the profile for this area, and we can confirm in a second with the profile tool, clearly I can say that roughly the same 70% of the price is here, inside this box, because it's where the price more time is spent. And when it goes outside here, it's an opportunity, right? So this is the Elliott wave count. In order to validate my wave count, and we are going to check it with the profile in a second, here, if this is the end of 4, we are going to have here the 1, 2, 3, 4, 5. Great, we have a 5. Now what? We need a 3 down that fails to make a lower low, and then we buy it. How we can know that this thing is going to fail? Well, we can go from a simple trend line breakout after a 3-wave sequence. We can go with an inverted head and shoulders formation. I don't know, anything you want to apply to find a reversal there. And if you don't have any reversal and the price just makes a lower low, here we can buy it, because we are going to have a fantastic opportunity. Of course, if it reverses a little, right? So that's a strategy from Elliott wave. Now let's find on the live market the best price to do it. All right. So first of all, this beautiful chart that we have here is showing daily profiles. So we have a lot of daily profiles. Remember that each blue box is a day on the futures market. This is the ES. And let's check, for example, the volume profile from today well, from yesterday, because the market closed at 5. So if we are already at 9 New York time, the market already is in a new day, right? So this blue box here, this one here, is the profile from yesterday. That actually is today. Weird. Look, the point of control was here of the session. Huh, incredible, right? That was a point of control. Institutional traders were doing something there. What they were doing there? Of course, they were buying. If they were selling, the price will continue lower. Okay, that one was easy. Look at the previous example where we have a similar pattern on the profile. Right here at the top edge, we have the same thing. We have the profile. They were selling because look where the price ended. Now, if we zoom out a little bit more, we can see that below this area, there is no value. The value was here at the 390. So this is like a void, this area, where it's not likely to be volume. And if the price crosses this area, we are going to this level. In case that this is not the end, we are going to this level. Trust me, and you can take notes of that level. Is the 3394. If we have a bearish breakout, we are going there. All right, but let's continue thinking that the market, that the ES ended the leg. So we go here to let's go to the 5-minute chart. We do the profile for the move up. I'm taking just the price on the screen. So look, if this is our wave 1 here on the lower time frames, and especially during this volatility, we are not going to ask for a perfect pattern. 3, 4, 5, fair enough. I think this is the wave 1. And I think that we are in the wave 2. Where is the point of control? 3, 4, 2, 2. 3, 4, 2, 2. That is where it's likely to end to finish wave 2. And here we are really expensive. Look, there is no volume. Price needs to go down. Price needs to give us the retrace. The value area for this profile is going to be here. Of course, once during the road, we make some adjustments. We can adjust the profile once the candles start showing up. But this area is important. 34.22. So let's say that tomorrow, or if you don't sleep, I have some friends that don't sleep at all, almost. So I sleep actually. I have my full night sleep. But in case that you don't sleep and you are watching the chart the entire night, and let's say, or tomorrow, we don't know when. Let's say we are already in the future. We are ready to tomorrow, and the price does a 3-wave sequence like this one, beautiful like this one. So I'm going to call this beauty A, B, and C. And if it bounces from the profile, I'm going to buy it. But you will say, why you want an institutional price? Well, from the big picture, I'm not using an institutional price. I'm just using this profile for this area, but from the big picture, look at this beauty. If we add all the profile for the corrective, right? Since it started right here, and you get used to use the tool. Don't worry, it's a matter of practice, but you need to know all this information. I'm sure you need to watch this recording several times and take notes and do your own homework and do your own discoveries. But look, the real volume of the entire drop is up here. So if the price give us this move down, we are at the cheapest part of the whole profile. And that's going to be our next target if this works. It's going to be 34.91. 34.91. Now, a little bit of common sense. If right now the price starts dropping and makes this thing, and makes a low, we are not going to buy it. That's one of the huge mistake that most traders do. The price starts going down and they buy. Why? Oh, because the profile. No, wait for the 3-wave sequence. Wait for the price losing momentum, showing a divergence, whatever, reversals. A regular reversals. When you are on trading 101, one of the most simple things that you learn on basic technical analysis is that when you have a leg down, and the price bounces and it retests and fails and then reverse, it's called a W reversal, and you buy it here. Or the same for the M pattern or the head and shoulders. So all those basics, never forget about those basics. Apply those basics on finding the reversal of a trend here. Let's say the price does W. Let's say that the price does the three-wave sequence losing momentum, and you have some sort of inverted head and shoulders, and you do all the tools, you apply all the tools that you already know, candlestick reversals, price action techniques, everything you can apply here, right? But that's the area to apply them to validate if the big guys are thinking the same as we are thinking. We are not going to never know in a 100% what they are planning, but this tool is the closest thing we can have to reveal what they are doing. So let's see how it works out. We do the entire homework. Elliott Wave, that is my favorite. A tool to understand where we are, to understand the market context. Then we apply a volume profile to understand when the price is cheap, when it's expensive. And then we create a strategy, a price action strategy. On the next class, I'm going to reveal my favorite, my secret price action validations to know when the trend is ending. High probability. We're going to learn that on the next class. All right, traders. So now I'm going to stop the recording and then I'm going to answer questions. I'm not going to record questions. And for the ones that are watching the recording, have a great evening, and I'll see you tomorrow in the next one.